Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. All right, we're going to be talking again back to this on taxes. I want to finish out that little bit I was doing before the break, and that was explaining how the progressive nature of our tax system works. All right, so let's look at this next slide, how taxes owed are calculated. So as I mentioned, you've got your standard deduction, the 20, again, married couple age 65, that's $28,700. First $28,700, you pay zero tax. Then on the next $20,000 for a married couple, $20,550 is taxed at 10%. Then you have, and they're showing a single on here, on this chart. On it, you're seeing that it's basically at about half. So you've got $14,700 for your standard deduction. You've got then the next $10,275 taxed at 10%. So you've got $1,028 on that for tax owed. Then the next approximately $30,000 is taxed at 12%. So there's $3,780. 22% for the next approximately 50-some thousand, and you can see how on your left there, as that as the effective tax rate goes up from 24 to 32 to 35 to the top bracket of 37. So in this example, what we're showing is a single person with a total annual income of $150,000. So in this situation, she's going to subtract her standard deduction, and because she's over 65, that's $14,700. Then the new number of $135,300 is her taxable income. So that's the difference between your adjusted gross income, your AGI, and then you take out the standard deduction, and that gives you now your taxable income. And then you see the tax owed, and you keep rounding down. She ends up on that $150,000 of income. She's got $26,300. She is in the 24% tax bracket. Okay, that's the upper bracket at which she's being taxed on some of those dollars. Again, it's a progressive. So just because you cross into a different bracket doesn't tax everything at that rate. And that's why the effective tax rate, because some is taxed at 10%, some at 12, some at 22, and some at 24, even though she's in that 24% marginal tax bracket, her effective tax rate is 17.5. Okay, so that kind of gives you just a brief tutorial on how the system works, why we call it the progressive system. As you go, the more income you make, you go up, ratchet up those tax brackets, and of course the amount of tax. Now, let's look at well, before we do that, let me throw something out to you. One of the things I've been talking about is on the show is different reports that we give out, and one of them I just got into a little bit was that 4% rule, and this has to do with how much money you can take from your retirement account safely without running out of money. And it used to be a rule that developed back in the 80s and 90s called the 4% rule, which said if you took 4% out over your lifetime, you should be safe and not have to worry about running out of money. However, that rule changed, in particular through 2000 through 2009, what we call the lost decade, where the market was actually down for a 10-year period. Okay, in that time frame, or down for the total 10 years, that up and down period. All right. Now they just said, oh, maybe that's not such a good idea. In fact, Morningstar did a report recently, and they said lowered to 3.3. If you're a research nerd like me, and you would like to, get this full report from Morningstar, again, call my office, and we can help you with that as well. And if you'd like to get, in addition to the research pieces that I share with you, if you'd like to get a comprehensive financial plan done, you're looking at these things and you're saying, yep, these are some good tips. They're helping you, understand things better, seeing where you need to pay attention to help manage your taxes in retirement, as well as how to manage risk in retirement to minimize that through your retirement years, how to get the money that you need to attain and maintain your standard living and quality of life. So when those paychecks go away, right, and you're going to need to, what are you going to have? You're going to have Social Security. Maybe you're going to be one of the fortunate few that have a pension. Any other income sources? Are you going to have rental property maybe? After that, it's your retirement accounts, right? You're going to be pulling money out of those retirement accounts, out of your retirement savings. How do you do so in a tax-efficient way? Well, we're going to get into that, and we get into it with your individual planning. So if you need some help, these tips are to help you see how these things work. Maybe you can apply some of this in your situation, but it's also to get you to seek out competent help with that. So to seek out your current advisors and talk to them about these things and have them help you develop that tax-efficient income plan in retirement as well. If you need some some help with a comprehensive plan, which of course includes this piece as well, call my office, 615-376-5325. So if you don't have someone to help you with that, or the person you're working with maybe doesn't do this kind of work, maybe they help you strictly with the investment side, or your tax person just with the tax part, but they don't put all that together and help you with a comprehensive plan for your retirement, again, call my office. We can help you with that. Or if you maybe just like a second set of eyes on something, a second opinion to see if you're doing the right things for you to maximize your retirement. 615-376-5325. I'll do a comprehensive financial plan for you at no cost. I'm going to invest some time into you, right, as a way to introduce the things we do, as you see here on the show many times, help you develop a plan that's going to give you some real value there, help you minimize taxes in retirement, how to manage the risk on your portfolios and on your investments in retirement as well. It's a very comprehensive plan. We talked to you about Social Security and Medicare. We get into all the different areas, all the complexities of retirement and all the tough decisions you're going to have to make, and help you make the right choices. So again, 615-376-5325. Just call the office. We'll get you out a packet of information to bring to your appointment with me, and we'll help you with that planning. And when you come in to see me, I'll also give you a free copy of my book, 7 Steps to Financial Freedom in Retirement. All right, let's go ahead back to the tax-efficient planning. So now there are three categories of retirement income when it comes to retirement. First is taxable. Second is tax deferred, and the third one is tax free. Okay, so many retirees draw income from multiple sources, in fact, and all these sources fall into these different categories. And remember, when I use the terms, I'm talking about the tax status of the withdrawal. In other words, when you hold money in a brokerage account, as an example, and you take money out, that's going to be taxed, whether at ordinary income tax rates or at capital gains rates, right, or interest earned on bank accounts, as an example. That's taxable when you take that, each year, rather, whether you take the money or don't take the money. Tax deferred, on the other hand, that's where you've got money in, of course, your retirement accounts, IRAs, 401ks, 457, 403b, SEP IRAs, TSP, your thrift savings plan for federal employees and military out there. All of these, if we're talking about the traditional plans, we're growing on a tax-deferred basis. You put the money in, you don't have to pay tax on it. And when you take the money out, of course, it's fully taxable to you, and at ordinary income tax rates, which are the highest tax rates. The next is tax-free. Typically, tax-free would be things like municipal bonds. Of course, life insurance, by the way, certain cash value life insurance has tax-free benefits. And then you have, of course, one of the big ones is Roth IRAs and Roth 401k, and TSP also has a Roth option. So if your retirement plan allows you maybe to put money in on a traditional basis and money in on a tax-free basis or into your Roth account. Most of them, when it comes to most of these accounts, if they give you, say at your work, if you have an option where you can put it in on the traditional and on the Roth, you want to weigh which one you do, and sometimes it's a little bit of both. So for instance, if you're in a 12% tax bracket, you might, there I would suggest you're probably better to just do Roth. All right, because it's only a 12% tax you're saving, and taxes in 2025 with the sunset provision of the Tax Cuts and Jobs Act, we're going to see taxes go up. So in 2026, that current 12% bracket is going to become 15%. The current 22% bracket is going to become 25%. 24 is going to become 28, and so on up the ladder. So for that reason, you want to be thinking, well, this is actually a time that paying taxes may not be a bad idea, because later my taxes could very well be higher. So this is one of those reasons, when it comes into planning, knowing how these rules work are real important to making the choices, making the decisions you have to make that are going to affect you for many, many years to come. All right, we're going to need to take another break. When we come back, I'm going to delve into that in more detail and show you how you can, again, minimize taxes on your retirement income. First, the break. Join us here. We'll be right back on the Retirement Report.